Hi, everyone, and welcome to today's episode of Adapt and Thrive. I am thrilled to have Rob McLister with us today. If you're looking for the most up-to-date pulse on mortgage rates and all things mortgages, Rob is a mortgage guru. He is an interest rate analyst, mortgage planner, and a contributor for the Globe and Mail, and a mortgage strategist for mortgagelogic.news. Rob, welcome to our show today.
It is fantastic to be here. Thank you for having me.
Rob, we have two more Bank of Canada meetings scheduled for this year, 2022. One is scheduled for October the 26th, and the other one is scheduled for December the 7th. Given the current landscape, what do you anticipate we will see in terms of A, any further increases to the overnight rate, and B, the magnitude of these increases?
Sure. Well, it's top of mind question for a lot of borrowers out there. So, the fact is no one knows where rates are going. The best we can do is rely on market expectations. And that's based on folks that are literally betting billions and billions and billions of dollars on where rates are going to go in the future. So if we put some faith in those people, and, factually, those people are a little bit more accurate than economists most of the time, then the market is looking for another 75 basis points of rate increases from the Bank of Canada. And the Federal Reserve, which is kind of the most important determinant of rates in Canada, because what happens in the US filters through to Canada, given our economic ties. The Federal Reserve is going to hike rates potentially even more than that. So it's really hard to say, but through the first quarter of next year, the market's looking for another 75 basis points from here. And that would take prime rate, which is a very popular rate used for variable rate mortgages, up to 6.20%.
Mm-hmm. What is the likelihood that they will bump with large magnitudes like previously 100 basis points and 75 all in one chunk, do you think?
Well, the closer you get to the top, the greater the probability of smaller rate increments. And that's because central banks, are like any other analyst watching the market and watching the data. They don't know exactly how much it's going to take to get inflation going in the right direction. So the closer, the more they hike, then the more they tend to fine tune their adjustments to monetary policy so that they don't overdo it. And as try as they might, they typically do overdo it.
Okay. And what should we look for in terms of indicators that this bumpy ride of overnight rate hikes is done, or is at least nearing the top or nearing the end?
Yeah. Well, you're going to see kind of lagging indicators like unemployment start ticking materially higher. We saw a half point jump in unemployment. That's a key number for the housing market. The Bank of Canada, when the Bank of Canada and the Fed start talking about a pause, okay, that's when I think you'll see the bond market start pricing in a greater chance of recession and a U-turn in rates. And, we're not near that right now. I think the Fed, from their language, they're talking tough. They're talking about another, taking rates up, potentially as high as 4.5% to 5% in the US. And, they're talking about rates being positive on a real basis. That means that the effective rate is higher than the rate of inflation, and we got a ways to go to get there. So I think sometime next year you'll see the Bank of Canada and the Fed tone things down and start talking about taking a wait and see approach. And when that happens, then hopefully the worst has passed in terms of rate hikes.
Makes sense. Okay. That's for variable rates. What are your thoughts on fixed rates? Where do you think those are headed?
Yeah, no one knows where they're headed. I can tell you that the trend is up. And we've seen a lot of lenders lately on the back of that, those Federal Reserve announcements, hiking rates because yields sprung up a lot, but it's very volatile out there. It's a thin market. Bonds liquidity is thin, and so you see these big whipsaws. There's tremendous uncertainty, and so yeah, the trend is up for now, but that could, ask me next week, the answer could be different. And now that's in the short term. Longer term, obviously, we all know what's going to happen. The Federal Reserve and the Bank of Canada are going to break the economy, and interest rates are going to top out, start heading back down when they have to add stimulus. So that's, when that happens is anyone's guess. If you look at the forward market and the bond, what bond traders think rates are going to do in the future, the implied future rates are lower starting about end of 2023. So, that's our best guess. And so we're going to see rates top out. Typically rate cycles like this are 2 to 3 years, but you can get much longer ones. Look in the 70s, right? Generally speaking, when prime rate is well above its 10-year average, you are going to see a much greater probability of success than like a variable and whatnot. And so I think that near term, it's anyone's guess, but longer term, we're going to see rates revert to the mean.
Okay. For clients then who are coming out of a renewal right now into this new rate environment we're in and heading towards, what are the key things that that would guide their decision when it comes to choosing a term? Should it be a 5 years variable, a 5 years fixed, or a short-term fixed? What are some of the things they need to keep in mind?
Well, term selection's a pretty complex proposition. I mean, you're looking at all kinds of things, the borrower's qualifications, the risk tolerance, what their 5-year plan is. They plan on upgrading their house, selling, and maybe renting, or what's the probability of breaking the mortgage early is what it comes down to. And then, with that, you can kind of gauge your prepayment penalty risk. So, as many of your viewers will know, there's penalties for breaking a closed mortgage early. And so, if you theoretically knew there's a high probability of you breaking your mortgage before 5 years, then you wouldn't want to get a 5-year fixed. You'd look at something like a variable or a shorter term, or a HELOC, or with an open term, or what have you. So, in terms of speculating on future rates, that's a very small part of the process because it's so opaque in terms of the future for rates. But, like I said earlier, long term, rates are cyclical. And so, right now for well-qualified borrowers, we're talking about, 1 and 2 year terms, open terms. If you're already in a variable, maybe riding that out more. Again, these are for well-qualified borrowers that can handle some rate volatility, because odds are in 18 to 24 months, rates are going to be lower.
Okay. So variables right now are above or at fixed rates, and the value or the advantage they had in the past have diminished. Do you still see value in sticking with a variable rate?
Yeah, I think so, because especially if you have a good variable discount, there's some folks that had, prime minus 1.3 percentage points or so. And, like I said, when prime rate is over 50% above its 10-year average, the probability of outperforming and a variable rate versus a fixed rate is significant. Well over 90% probability of success. There was one time in 1978 where people thought they had inflation under control, and then rates ramped 1,450 basis points, I think, in about 42 months. That's one of very few exceptions, right? But the exceptions do happen, and so it's first and foremost a question of risk tolerance and managing risk. And so maybe a full variable is not the right move for a particular borrower. Maybe they need to kind of hedge their bets a little bit in a hybrid, part fixed, part variable. And you can choose how big you want those parts. Or maybe a middle of the road term, like a 3-year fixed, is more appropriate than a 1 or 2 year. So it really is very borrower dependent.
I love the idea of the hybrid option to hedge. That's a cool one. Rob?
Yeah, I mean, it's like, investing. fast growing growth stocks aren't necessarily the right move for everyone. That's why people do part fix or part stocks, part bonds in their portfolio.
True. Rob, I'm hearing about extended amortizations up to 40 years. Do you think that is something that's going to materialize? Because I know qualification has gotten tougher and payments are higher. So what are your thoughts on that?
Well, hearing that mostly in the realm of insured mortgages, the Department of Finance has looked at that. I don't know exactly where that's going to end up. I know that from what I hear in terms of talking with insurers, there's some research being done in terms of how many people are needing or requesting amortization extensions. And so whether they actually make that an official public policy for all people renewing their mortgage, and that is, make it a policy that you can extend your mortgage amortization if you need to, if you're having trouble making your payments. Whether they do that or not is anyone's guess. I would put it less than a 50% probability based on my recent discussions on the topic. But if you see unemployment spike way higher, and you see rates go further up, and you see the economy slipping significantly, then anything's possible. I mean, the Department of Finance has control, the OSFI has control over qualifying and over debt service guidelines, and they can literally make or break the housing market with one decision. So they have a lot of power, and so whether they use that power to kind of counteract the negative cyclical effect that we're seeing right now is anyone's guess. But I think they're going to take a wait and see approach for the near term.
Okay. Lastly, for those who are in a variable rate mortgage and have seen their payments go up because they've hit their trigger rate, or those who are in an adjustable rate mortgage and obviously their payments have gone up and are experiencing financial pressure, do you have any strategies or tips on how to deal with these increased payments?
Yeah, so again, it's a borrower specific question. A lot of people say, hey, if you can't make your payments, you should just sell your house. But obviously that's not practical, and most people want to keep their roof. But the fact is that sometimes you get in a bind, and if you have a reduction in income, you need all the help you can get. And so, if you can qualify for a refinance, and you have the equity, that's one potential option. I mean, if you only have 20% equity, maybe you're limited to extending your amortization out. If you have 35% equity, for example, maybe you have more options. You can get a home equity line of credit for extra liquidity. If you can refinance into a home equity line of credit and take advantage of interest-only payments, that could significantly reduce your payments. And this is a short-term solution. Obviously, no one wants to, most people don't want to pay interest only on their mortgage. But when times get tough, sometimes you got to do what you got to do. There's certainly a lot of non-prime lender options out there. If things get really tight, obviously you're going to pay a higher rate, but you have much more flexibility with respect to debt service ratios and stuff like that. And there are lenders out there that offer great flexibility with interest-only payments, or amortizations up to even 40 years now. So those are a couple options.
Fantastic. Rob, thank you so much for being here with us today and for your advice and insights. Where can we find you to stay on top of mortgage updates and to follow your research?
Yeah, I write up a bulletin for the industry and for investors and lenders and brokers every week, and it's at mortgagelogic.news.
Okay. All right.
There it is.
Got it.
Yeah, thanks for having me. It's a good time.
Thank you, Rob. Thank you very much.
Cheers for now.
Cheers.